One of the hardest parts of trade management is that the right decision is rarely obvious in real time. In this trade, I did not trail the stop, even though the market had already moved far enough that some traders would have chosen to protect open profit. My reason was simple: I was still hunting for a short position on the daily chart, and the broader bearish bias had not changed. That distinction matters. Trade management is not just about locking in gains. It is about preserving the best expression of your original thesis while respecting risk. When the higher timeframe setup is still valid, tightening the stop too aggressively can convert a good idea into a string of premature exits, followed by the costly process of re-entry. And re-entry is not free. It is not just spread or commission. It is also the loss of continuity in the trade. The daily chart was the anchor. As long as that structure continued to suggest downside pressure, I did not want to manage the trade as if the thesis had already failed. Lower timeframe movement can help with timing, but it should not automatically override the larger directional view. This is where many traders confuse comfort with discipline. Trailing stops can feel prudent because they reduce uncertainty. But if the market is still behaving in line with the original bias, an overly reactive stop can force you out before the move has actually played out. There is a real hidden cost to trailing too early. Every time you get stopped out prematurely, you have to decide whether to re-enter, at what price, and with what emotional state. That friction can reduce conviction and distort timing. One planned trade can turn into several inferior decisions. Risk management should match the horizon of the thesis. If the idea is based on the daily chart, then management should also respect that timeframe. Using an intraday impulse to manage a higher timeframe trade often creates unnecessary noise. That does not mean ignoring risk. It means choosing the form of risk control that best fits the setup. Sometimes that is a trailing stop. Sometimes it is patience. The key is to avoid mixing emotional protection with strategic protection. The framework I was applying was simple. Respect the timeframe that created the trade idea. Do not shrink the thesis because of short-term noise. Recognize the hidden cost of repeated re-entry. Let the market invalidate the bias before changing the plan. Use stop-loss placement to survive, not to micromanage every fluctuation. In this case, the market came near the stop and then rejected strongly downward. There was some luck in that sequence, and it is important to acknowledge that. Good process does not eliminate randomness. It simply improves the odds that randomness does not dominate the result over time. Many trading mistakes come from managing a position too early, not too late. Traders often think they are being conservative when they trail a stop aggressively, but they may actually be reducing the quality of the original trade. The better question is not how to avoid giving back every cent of profit. The better question is what management choice best preserves the edge of this setup. That is why I did not trail the stop. The daily bias was still intact, the short thesis was still alive, and I wanted to remain in the trade long enough for the downside scenario to develop. In trading, survival matters. But so does giving a valid idea enough room to work.